This episode is brought to you by True America Multifamily, one of the nation's leading multifamily investment firms. In 2025, True America partnered with Manulife Investment Management to launch the $1 billion joint venture, Anchor Point Residential, created to acquire and preserve income-restricted multifamily communities, supported by low-income housing tax credits, LIHTC. The initiative begins with 51 properties, about 6,000 units across California, Texas, and Washington.
Hi, everybody. Welcome to Building Better Communities. This is the podcast where we explore people, ideas, and investments shaping the places we live. I'm your host, Bob Hart. Well, welcome. Today, I am thrilled to be here with someone I've admired for many years and I've known for over a decade, Mr. Terry Considine, the CEO of what is now called Big Four Properties, one of the most influential leaders in multifamily real estate today. Terry has spent 5 decades in this industry, and he has reshaped many platforms across the industry, from founding Aimco, taking it public in 1994, to creating AIR Communities, and now building Big Four Properties. And what's really interesting about Terry's career is he hasn't just invested in real estate. He's repeatedly built and scaled and repositioned entire platforms across multiple cycles that have been tested. And today, as he approaches 5 decades in the industry, his new company, Big Four, is already out acquiring and repositioning assets across the country from diverse locations as Hollywood, California, Louisville, Kentucky, Kansas City, Missouri, and Greater Boston. So Terry, welcome to the show, my friend.
Hello, Bob. Thank you for having me.
Well, I've wanted to get you on here for a while. You were playing hard to get because you were in a public company. So now I got you where you can talk.
Yeah, now I can tell you everything.
So before we begin, Terry, I just want to highlight for the viewers some of the milestones of your career. So before you founded what everybody knows to be Aimco in 1975, really, and I believe that was the outset where it was started as the Considine companies?
Yes, sir.
Which you took as public as Aimco in 1994. You helped over 3 decades to eventually evolve a portion of that platform into AIR before you sold Aimco, I believe, to Blackstone. And that was just last year.
I sold AIR to Blackstone.
You sold AIR to Blackstone.
$10 billion almost 2 years ago.
So AIR was the spin out of many of the Aimco assets.
Of Aimco. And Aimco, I chose to liquidate, and it's about halfway done. It's led today by Wes Powell.
Yes.
Who's a wonderful, capable CEO, dear friend. And
who you handpicked many years ago.
Absolutely. His father.
Did he know he was going to work himself out of a job, Terry? Did you disclose that at the time?
You know, I don't know that he'll ever forgive me, but Wes and his top team, Lynn Stanfield and Jennifer Johnson, are just the best we ever had at Aimco. And they're there, and they've done a great job of maximizing value to shareholders and liquidating the Aimco properties, which were all the tough ones. AIR had all.
You've always told me that the value in Aimco was its operational edge. And clearly, a guy named John Gray figured that out and paid for it.
John did, and he paid a handsome price. You won't be surprised to learn that I was.
You didn't take advantage of John Gray, did you, Terry?
No, I didn't take advantage.
He usually takes advantage of other people.
I don't know if he takes advantages of other people, but he made a very shrewd buy, because what he's done since then is to combine all of their multifamily, and they have, I think, about 500 properties, 177,000 units. And so it will be the largest apartment operator in the United States, probably in the world.
Yeah. Well, I think Greystone operates quite a bit, but a lot of it's third-party managed.
Yeah. In this case, they'll own it. 68 billion of AUM.
Yeah. I've had to turn over a few of my partnership assets with Blackstone to your successor management company. Thank you, Terry.
Well, I just, you call John,
Terry, you're ubiquitous. You're everywhere. No, I'm not going to call
Uh,
John over a couple of minutes.
But I was thinking is that 68 billion at the rate you're going, it's only a year and a half or two more before your AUM equal that. So it's coming.
65 now, Terry.
There you go. There you
I'm
go.
following your footsteps. I got into affordable housing, so
Yeah. Yeah.
I'm no, we're getting closer to that number every day. We're
Good for
almost
you.
there.
Good for you. Well, you're
Um,
you're you're a dynamo.
oh, well, thank you, Terry. I've learned at the knee of the best here. Okay, so Terry, you're like the Babe Ruth of apartments. I mean, you've operated across like a million apartment homes over your career.
Yeah.
Why Big Four now with a focus on value creation and community impact at this stage of your career? What's happening here?
Well, when I sold AIR and helped decide to liquidate Aimco, those were the two of the seven public companies I've had. It wasn't that I was tired of the apartment business. I missed being in the real estate business, and I was tired of being public, and I wanted the opportunity to spend my time buying real estate, which you do so well, but there's a lot of joy in figuring out location and communities and target customers and building an operating team. And it's very gratifying to me the number of Aimco alumni that have offered to help put the band back together again.
Part
And
of the people you have in Big Four?
yeah, and so we've got about 55 people right now, and I would guess all but 5 or 10 are alumni. And so that means we know each other, we have common vocabulary, we know our systems, we speak the same language, and we like each other. So that's a positive. And so people like Matt Island and Josh Minix and Matt O'Grady are just known commodities. Known commodities doesn't sound right. They're my partners. They're people I have a high regard for, affection for, and Bob, I think the thing
Rolling
that
Stones going on tour again.
it's kind of like that. That's
You're
right.
front
I
and
can't.
center. You and Mick are front and
Yeah,
center.
I can't move like Jagger, so
I think, Terry, I've watched you, man. You move pretty good. Okay.
well, I don't know, but probably the most determinant factor in my life is I'm the fourth of 11 children, and I have 7 brothers, 3 sisters, and so being in a family and having relationships and working with people is the most fun thing to me that I can imagine.
And going back to those days uh, in the late 40s, I won't tell
Yeah.
everybody your exact age, so I'm going to leave that to chance.
April
Okay.
8th, 1947. I have a birthday
I
coming
know
up.
next week.
Yeah, next week,
I'm
exactly.
going to have a belated birthday dinner with you in Denver.
We're going to have it
I'm
together.
paying. You can't
and
pay. I'm paying.
And
Okay.
then we'll call Bill McMorrow, whom you interviewed on this program recently, and
We'll harass Bill a little bit for.
yeah, we'll sing happy birthday to him too.
Yes, we will. His birthday is on tax day, so he never comes to the office then.
Yeah, well,
That's his
I
thing.
on tax day, it's painful. It's hard to get out,
Yeah.
particularly when you're succeeding the way people in Los Angeles do. I mean, it's those
Well, we
tax
live
days.
forever here in LA, I think.
Yeah, right.
That's why we live here. That's why we pay 13.9% of tax. We're not like Coloradoans, like you guys.
Colorado is becoming more like California than I like
It's
to admit.
becoming more blue
Yeah,
than purple.
it really
Now,
is.
you ran for state senator there and won a couple of times, right?
I was elected to the state senate twice. I was nominated for the U.S. Senate in '92 and lost that race. And I've managed campaigns both in this state and in California and around the country on issues that were important to me. Prop 13, I was involved in term limits. It was a cause that I took to about 24 states. So
I think everybody knows your full background, that you grew up in Southern California. You went to school in the East to a Massachusetts prep school, Groton,
yeah,
and then stayed East,
yeah,
not far from where I grew up in greater Boston, and went to Harvard,
yep,
and then to Harvard Law School.
yep.
So before you got into real estate, it seems like your ambitions were a little different. They were more centered in law and maybe politics.
Politics has been an interest all my life. I
Yeah.
was along the way. I worked in campaigns. I was an intern for Governor Reagan in Sacramento.
Wow, that's in the 60s.
60s, yeah, going through college.
He
Uh,
followed Pat Brown, or six? I'm trying to remember
he
which
he
order it
followed
was.
Pat Brown. Mhm.
He followed Pat
He,
Brown.
he beat Pat Brown in Pat's third election. Pat was
Oh, okay.
elected
I didn't know
in
that.
yeah, Pat was elected in 58
Twice.
and in 62, and then he lost in 66 to
He
Reagan.
beat your friend Richard Nixon.
My close personal friend, President Nixon.
The Republicans can't win all the time, Terry. Let's get this straight, okay? This is
They
an
can't
era where
win all the time.
Democrats were like Republicans, but they're not, it's a little different today.
Pat Brown was quite a good governor, and
He was an excellent governor. He
yeah,
evolved the education system here in California.
and he built the water system.
Built the water system. He was a great governor.
He was a great governor. He was a great governor.
Reagan was a good governor too.
I'm sorry?
Reagan was a good governor. He was a good president.
Reagan was another very good governor. And Jerry.
Today, Reagan would be like a Democrat in comparison to what we have now.
Compared to what we have now. That's exactly right. What we have now is problematic for the housing industry, and I don't think it's been particularly good for the state. But
No,
so that's just a national issue that we have to address, not just in California, but in Colorado and around the country. And as a national investor, you have to be very mindful of the regulatory regime where you invest.
Well, it's one of the biggest harbingers of preventing third parties who don't know much about it to give you their capital. They don't want to be squashed in a regulatory situation. They want to make money.
That's
They're
right.
trying to put their money to good use. I mean, we're doing essentially workforce housing, you and I, and that's the last thing we need. But we're facing it in many, many places now.
And it's ironic that the areas of the country that have the lowest rents, that are most affordable, and where rental rates are actually going down, are in the very competitive red states, where builders can build and take entrepreneurial risk and create homes that are attractive and more affordable for more people.
No, I completely agree. It's really in areas that have had less regulation, like Austin, Texas, where the consumer has benefited. Developers have built a lot of housing, which has softened rents
It's been
and has
hard
really
on rents.
empowered the resident to make more housing choices. So
That's right.
it's not great for existing owners, but it levels itself out. So it just goes to show you less regulation, better for consumers.
We believe in competitive markets, and competition
Yes,
is hard, but it's a good discipline, and it's good for productivity. It's good for wealth creation for all people, and it provides good homes at an attractive price.
Terry, let's just roll it back a little bit again. So you remained in Boston, and I believe as a practicing lawyer, you somehow got involved with Cabot, and Forbes, a great old line Boston name.
Well, Bob, you've simplified it a little bit, but with 11 children, I was working my way through law school. And I taught freshman English at Harvard College, and I worked at Hale and Dorr.
Oh, you worked at Hale and Dorr. Wow.
Yeah, as a clerk. And at the time, the managing partner of Hale and Dorr was a wonderful man named Paul Helmuth. And Paul was also Jerry Blakely's partner at Cabot, and Forbes.
Got it.
And so Paul probably took pity on me and saw that I needed more work. And I did work for Cabot, and Forbes. And
let me just educate the viewers, because some viewers may not know, but these are very good names in the Boston area. Hale and Dorr is one of the most prestigious law firms in the country. I think it's been around since Washington sailed up to Delaware. I mean, it's been around a long time. And Cabot, and Forbes is also a great old name in real estate as well. So you've associated with some really good brands over a long career.
Well, Jerry Blakely was often thought of as the father of 128 and the development of industrial parks and garden parks. He's also built office buildings office buildings in Boston, like 28 State Street, 60 State Street, One Boston Place. He owned the Ritz-Carlton Hotel.
All signature assets on the Boston skyline.
And so he did that, but he also had a national business with industrial properties in King of Prussia, for example, or in Southern California. And he was a developer of Laguna Niguel in Orange County.
Really?
Mhm.
Okay.
That's where I first ran across them. I was working my way through college then, selling advertising. And
You were selling advertising in Cambridge or wherever.
Well, in this case, it was back in California during the summers on a
Oh, you're
weekly
doing it in the summer between between
sort of
years.
a shopper, a free newspaper called the San Clemente Independent. And a dear friend of mine from San Diego had started it and gave me a job. I thought I was going to write important op-eds about the future of the world. And he said I could do that, but my compensation would be 25% of the advertising I sold. So markets
You were
came to
living by your
mind.
wits.
I had to learn how to sell advertising. And
And the
it was,
customers were small businesses.
yep, you bet.
Did you ever have lunch at the El Adobe there?
I think so. Although I
That was
forgot.
Nixon's favorite spot there in
Yeah,
downtown San Juan
but
Capistrano.
I would be more likely to have had it at McDonald's, but because I would be my gas bill then was more than my comp in the early months of the summer. And
Sure.
it's a cumulative business. And so by the first in June, I might have made $300, in July $1,000, and in August 4,000, and then I'd had make 6,000 in September, and think, should I go back to college? Because how could
Oh,
anyone ever spend $6,000?
well, San Clemente is filled with small local
Yep.
businesses. And back then, I don't even know how many it had. And if they were advertising in a local paper, it'd be people in the surrounding area. But how much was an ad back then?
$100, 125,
Okay.
75. Do you want a quarter page, or we have a special going on for a full page? I could
You're still, I
probably
love
help
it.
you with occupancy, but
Oh my God, that's
yeah.
fantastic. So that was the summer gig for a couple of years
Mhm.
while you were
That's while I
going
was an
between.
undergraduate,
Oh, that was undergrad. Okay.
and then in law school, I taught freshman English at the college, and I worked as a law clerk at Hale and Dorr.
Okay. So no shortage of work in your life.
No, I had the best parents ever, and one of the things they thought was that we should learn how to work, and we were raised on a ranch in part, so we had many opportunities to learn that lesson.
Yeah.
And
Where was the ranch, Terry? In what part of San Diego County?
it's Valley Center. It's sort
Valley
of
Center.
north of Escondido, south of
Got it.
Palomar Mountain. Um,
And what did they grow? What did you guys, were you cattle ranchers?
Alfalfa,
Okay.
citrus, lemons, limes, grapefruit, oranges, avocados, walnuts,
It was a
and
working
cattle.
ranch.
Working ranch. Hmm.
Okay.
Probably there are laws that were meant to protect child laborers that didn't apply to us in time, but we had to
Well,
get up
those
and
were the
change.
years of Cesar Chavez in California.
Caesar came later. Caesar came
Yeah,
later.
late during kind of the
Right.
when Bobby Kennedy embraced him, I remember
Yeah,
in the
that's right.
60s.
But we had to do all our chores and then be in the car to go get to school because we were out in the country, and if we were going to get into town,
Wow.
Daddy was going to leave at 7 in the morning, and if you weren't in the car, you were left behind, and that was
So
bad.
those early years really informed your hard work ethic that you've embraced throughout your career.
I think so. I don't think of it as hard work. I think of it as a lot of fun. It's my favorite activity. If I were a better golfer or card player or skier or some such, maybe there'd be other things I'd like to do. But I love work, and I've if I'm not working on a business, I'm working in a community activity or political activity. But I like being busy.
I think the message then, Terry, for people that are going to follow in your footsteps early in their career is to find something they love because they will work harder at it.
Absolutely. I think that one way you know whether it's the right choice is how you feel about it. And if it's a chore, that's an obstacle. And if you wake up in
Yeah.
the morning eager to get going, sometimes it's because of excitement and ambition, sometimes because of fear and desperation. you know you're doing the right thing, and you can apply yourself, and you'll do your best work.
Early in your career, after all this hard work of getting through Harvard Law School, position at Hill and Dorr, you shortly made the pivot into real estate. Give us a little bit of that
Well,
period of time.
in my second summer at law school, I actually worked on Wall Street at a law firm called Davis Polk and Wardwell.
Mm-hmm.
Davis Polk did a lot of investment banking representation, and the summer of '67 rather was when I was there, and the REIT window was opening. And there's a generation of REITs that were established in Boston because the enabling law for REITs was passed in the last year of the Eisenhower administration in 1960. And it was originally intended to codify the way a legal structure called the Massachusetts Business Trust, which was a tax pass-through. And that's why so many mutual funds are based in Boston. It's a similar structure.
So they were allowing the pass-through of passive losses.
Well, of taxable income. They're just saying there wasn't
Taxable
a tax
income,
entity
ordinary
level.
taxable income.
That's right. And it could be a loss or income. And there's certainly been both, but the idea of passive loss hadn't come up yet. That came in reforming tax shelter.
Right. That was
Later.
reformed in 88,
86.
86. But Terry, let's go back here because you were at the footstool of the beginning of REITs. I mean, you were really there at the beginning.
I was next to the footstool. The people that did it were companies like Real Estate Investment Trust of America, RETA, John Gardner.
That was in the 60s?
That was 1960 that law was passed.
Okay.
But then afterwards, there were people like Jack Kershaw or Neil and Monty Wallace, and their family still is active in real estate.
And in those times, over 60 years ago, it wasn't like today where REITs have to be in the billions of assets. They were much smaller, weren't they?
They were, and they were. Many of them were sponsored by financial institutions like Northwestern Mutual Life or Chase Manhattan Bank, and so they tended to be more office buildings and shopping centers, and many of them were also construction lenders or permanent long-term permanent lenders.
Well, multifamily was not institutional quality in the minds of the investors in those days.
It was just coming into being regarded as investable.
Yeah.
And so what we did at Cabot and Forbes Land Trust is do land purchase leasebacks, which are kind of a mezzanine position, a ground lease, and so that's a good asset to own, I thought. And we raised $62 million in the initial IPO, and today, because of inflation, that'd be 600. And
who were most of those shareholders? Individuals?
They were mostly individuals, but there were a number of institutions. There are a number of institutions, and but mostly the REITs at that time were a retail product, and we raised our capital through Payne Weber.
Yes, I remember Payne Weber was big in that.
Like Albie Pratt and George Gardner were the bankers on it.
If you pause for a second on that capital formation. It seems like we've reverted back to that in the formation of these new private REITs from Blackstone and others to catch, call it the private wealth channel, if you will.
I think so. I think that's a very good point.
It's almost a reversion.
It is a reversion because real estate, I think, rewards being steady and inflation protection and income orientation. And it's not quite as what Wall Street likes, which is a concept that's growing very quickly, like artificial intelligence or like computers in their day or things of that sort in the dot-com era. And it also has a tax advantage, which matters to individuals more than it does to institutions.
Yeah, very much so. Well, I think that front seat that you had at the evolution of the REIT business before it was super mature was really a real benefit to you early in your career. Um, and it was just a different industry. There were probably more REITs back then, right?
I
Early
think so.
stage?
I
Yeah.
think there may well have been, but what was most educational was the recession of 73, 74. That was a very deep, very harsh time, and many real estate companies failed.
It was a
Uh,
wage and price issue with inflation, as I remember.
it was stagflation, high interest rates. Uh,
Nixon put in a cap on wages and things back then.
There were price controls. I've had
Yeah.
forgotten that, but he didn't put a cap on interest rates because they went up to the prime went to 22
It
in
was at its peak, right? In
at its peak.
1980 when Reagan came in
That-
and Carter was going out.
That's exactly right. And but that was a difficult time, but it was actually a great time because for a young person, I didn't know any better. There's a lot of problems that had to be worked out, and no one else knew what to do either, and so we had to sit down and figure them out. But I had a condominium business by the end of it, and I bought end loans from Freddie Mac at 19 and 3/8.
Wait,
And
let's before you go into that. So had you then left your law practice?
well, I took the bar in Massachusetts, but I never was a practicing lawyer.
Even
Uh,
at Hale and Dorr?
but I was a law clerk, by which I mean
Oh,
to
I
say
see.
I wasn't the a partner,
Okay.
and I was grateful to be paid for my services, and I had wonderful opportunities to work with men like Paul Bronsis, who was a well-known corporate lawyer in Boston, and he was chairman of the Dukakis campaign, and
Hmm.
also Wiley Vaughn was sort of the dean of real estate lawyers in Boston at that time.
Terry, you must have been a Boston sports fan then too.
You know, Bob,
The Red Sox won the AL pennant in '67,
I can tell you that I tell
right?
people I came to Boston in Ted Williams last year, and I
That
left
was
in
early '60s.
yep, and I left in Carl Yastrzemski's last year. Uh,
Wow.
I know who number
Okay.
4 is, and I know who stole the ball.
Okay. So you did go. You were a Red Sox fan of
Yeah, I was
sorts.
a great Red Sox fan,
We won't tell
and
anybody in Colorado that, Terry. Don't you worry.
you know
No one in
I
Colorado
went
listens to this anyway, so you're good.
I went out to the World Series when the Rockies made their one appearance there, and the Red Sox swept them. So it was pretty tough. But
Terry, when I was growing up in the Boston area and after the '67 year, the Red Sox just were not a great team. It was
yeah,
hard to watch.
yeah.
And now, if you look at the Red Sox today, it's a totally different franchise.
Well, you'll remember the year. I think it may have been 2002 or three when they finally won the pennant
Yes, I
and
do remember that.
the World Series, and it was the world shut down because they were down 3 games to the Yankees and came back to win. So that
That
was
was an incredible sweep.
yeah, and
That was that was a
business
Red Sox moment, I will tell
yeah
you. And there weren't
business
a
in
lot of
Boston.
those when I was growing up.
No, there
Trust me.
weren't many of them, but sure. So I've been out to Fenway Park. I remember the first time I went to Fenway Park, I was a freshman at Harvard College, and it was a spring afternoon. It was perfectly nice. I was there with my roommate Jim Bailey, and all of a sudden we saw 10 rows ahead of us our economics professor grading exams, and
Sitting
so
in the
yeah, in the
well,
bleachers.
I don't know if it was the bleachers or where,
It
but
was the bleachers, what we could afford, but he was there too, and we thought, should we go down and talk to him without help us or hurt us on our grades? But we broke down and went down to talk to him, and we both passed, I guess. So
you did well. Well,
yeah,
your timing is everything, right?
timing is everything.
So, so talk about the predecessor to Aimco, which is really the Considine companies of the early '70s. Is that right?
Well, I left Cabot and Forbes Land Trust at the end of April of 1975, and
Well, okay, so '75.
left because of a business disagreement over how we should react to the recession, that it was severe and our portfolio had been impacted too. Particularly, we'd done some land development lending, and I thought we should be very aggressive in pursuing our remedies and so forth. And the board was in a state of shell shock, I think, a little bit.
Yeah.
And but my own view was if there's a problem, tackle it head on. And so I was just wanted to be more active in our response. And so
They
I
were
left.
avoiding it, or what was the?
They thought if we just sat tight, that things would get better, that time would heal the wounds. Um,
Yes.
and I'm just not wired that way. And so I wanted to go see this as an opportunity, not as a negative thing. So it was a great time to go buy real estate. And so
Where'd the
I left.
capital come from?
Well, it's a Boston story. I sold a very important real estate asset. I had bought a condominium at 180 Beacon Street, uh,
Really?
Beacon and Clarendon, but
Beacon
it
and
cost,
Clarendon. Okay.
yeah, it cost $27,200. I had 95% financing, and I sold it for $45,000. So I
A
netted
windfall.
a windfall out.
That
All of a
wouldn't be
sudden,
your closing cost today.
I had 14 or $15,000, and I thought that was more money than that existed in the world, and that was my seed capital.
Wow.
Yeah.
So you took that and you parlayed it into what became the Considine company.
Yeah, and what I did was pretty much what I've done for the last 40 years or 50 years is I bought properties that I thought we could operate better. And I bought a lot of apartments during that time frame. I had partners that both were syndicators or foreign investors, but my best known partner was Richard Rainwater and the Bass Brothers. And
Oh,
they were great,
well, they
great,
they
great.
did very well during the RTC crisis, is when they
They
bought a
did
lot of
great.
bank assets.
They did great. Well, that was the time. This was before the RTC, but it was a
Yeah.
similar time in that you could buy things at depressed prices, and I've always liked that. I think we're in a little bit of a time like that today,
How'd you
honestly.
get to know Richard?
Richard called on me while I was still at the land trust, because the Bass brothers, who have great fortunes today, were just getting started, and they put a rule for Richard that he couldn't buy. He was buying public debt at discounts.
He
And
was the brains, the operative brain of the Bass Brothers real estate
yeah,
empire.
many people give him credit for that. I assume the Bass brothers had the brains to partner with him, so I,
They
I
inherited that franchise from their dad and then made something out of
yeah,
it, as I remember.
their uncle.
Their uncle.
Yeah, and
Were they
and
oil men first before
yeah,
they were
oil.
real
He was a
estate?
famous wildcatter. Yeah,
That's what I thought. Yeah.
yeah. And Richard was a very smart person, but he had to go visit each company management. So he called on me, and he wanted to know whether our publicly traded debentures were going to be good or not. And I told him I thought they would be, but we became friends because we thought the same way, kind of the way you and I have become friends.
Yes.
And we he was very smart. He's also very much of a family person, and usually he would say, "Come see me. I'm going to go to my daughter's soccer game or some school event," and I'd stand with him on the sidelines, and in between plays, he'd say, "How many units was that?" or "How many part? What's the cap rate?"
Was he from Greater Boston?
No, no, this is down in Fort Worth.
Oh, this is down in Fort Worth.
Yeah,
So you
yeah,
were
I'd
down.
go to
Okay.
Fort Worth to see him.
You would go visit him down there. That's what
Yeah,
I thought.
I'd go
The
see him.
Bass
Yeah,
Brothers were in Texas.
yeah, that's right. And so I did that over time. I also did LBOs during that time. I bought a CBS television station. I was the largest distributor of gasoline in the Southeast and 600 C stores, and I had a chain of environmental laboratories. But
Wow. Real
uh,
entrepreneur, Terry.
well, I've had trouble with steady work. I have some ADD qualities that made me want to look at a lot of different things, and I've
Well, it's
learned.
manifested itself in a very positive way.
Well, when I went from being the largest owner or distributor of gasoline in the Southeast in 1989, I think they
How
passed the
much was
leaking.
gasoline in those days per
Yeah,
gallon?
that's right. Leaking underground storage tank legislation, regulation. And I became the largest owner of leaking underground storage tanks. So I had to learn how to fix that. And that's when I started the environmental lab business.
I mean, you were the largest owner of leaking or
Well, in the Southeast. I mean, so it was an exciting time because I had a very big problem I had to fix, and I learned a lot about it.
that was pre-EPA probably.
EPA was just getting started. The EP had been started by Nixon in about 1970, and so this is 15 years later.
Okay. So you really got your, so to speak, got your hands dirty.
My hands are dirty all the time. I'm not
Started from those farming days, those
That's
ranch
right.
days.
I
It continues.
don't spend a lot of time sitting behind a desk. I want to be out where I can move things.
Oh, I know you like to be on the field. So let's talk about the inflection point between these entrepreneurial ventures or the Considine companies and what became Aimco. Let's talk about that. Now we're now in what year?
Well, there's an intervening chapter which I spent much of the 80s in politics, and I was
Oh,
elected to the state senate twice. I ran for the U.S. Senate in '92, but
in
as
Colorado.
in Colorado, I lost to a man named Ben Nighthorse Campbell,
Oh
and
boy, yeah, he's a known commodity.
yeah, he was. He's a very colorful person, and his television advertising had him with this long Indian headdress, riding a paint pony across a high aspen meadow. And even my friends would say, Terry,
Sounds like Putin did that, right? Didn't he ride a
well,
horse
he
across
did it
that?
before Putin. Putin got it from him.
But he did it shirtless, though.
Yeah, he did it shirtless. But
Just
people would
Terry, you
say,
should have done that. See,
I,
you could have.
I just I didn't have the flair.
So wait, what year was this, Terry, when you ran for
That
Senate?
was '92. But in '91, I'd rolled a horse at our ranch here, and I'd broken my back, and I was in the hospital for months, and I ran the start of that race in a wheelchair, and it worked for Franklin Roosevelt, but it didn't work for me. That's how Campbell beat me. But so to tie all these stories together on election night in '92, Betsy and I were driving to where the big rally would be, where the results were made known, and we knew that we were going to lose a little bit. And
Yeah.
she said, "Well, Terry, what's going to happen next?" And I said, "Well, Betsy, I'm now financially stressed by the lust regulation. I'm physically handicapped and politically rejected. I can promise you it's going to get better. And what I'm going to
You've been
do,
married, what, about 20 years by then? 18
yeah,
years?
yeah, that's about that. And
So she wasn't going to throw you out. Well, she could have, but
she is the most wonderful wife and has been a very good life
she's
partner.
your rock.
And she probably gave some thought to throwing me out, but then she wasn't sure I'd stay out. So I don't know what
You're too likable, Terry. No one would ever
no,
throw you.
I promise you. So, but I told her what I'd do is I'm going to simplify her life because this business had gotten complicated. And I was going to learn to walk without crutches because I was still on crutches.
Wow.
And I was going to be there to drive the kids to school because I'd been away too much during the campaigns. And so what happened in '93 was the REIT window began to open again. That's when, after a decade or so or 15 years with no IPOs, you had the development of the operating partnership. You had Kimco. You had these early REITs that came out. And there was another window where for 18 or 24 months, probably, I don't know, 50 or 60 REITs.
What was the opening of that window? What defined it, Terry?
I would say, I think it was the Kimco public offering
Kimco.
in about '93, but there was just a Taubman, DeBartolo,
It was the retail
the retail.
companies.
Yeah, it
Yeah.
came first with retail, and then Office Boston Properties and companies of that nature.
What made it feasible then? I'm trying to understand from the younger viewers that weren't doing what we're
Well,
doing then.
it was because of two factors. One was the real estate industry had been crushed by the elimination of tax benefits in the 1986 Tax Reform Act. And
Right. Oh, right. Exactly. Of
and the
course.
most aggressive real
That
estate
was
lenders,
brutal.
it was brutal. And the most aggressive real estate lenders of the previous 20 years were savings and loans, and they'd been largely bankrupted. And so we had the S&L crisis in the country.
Let's not drive by that because that was a telling period where I think it began in the Reagan administration, where there was a ton of deregulation that allowed a lot of undercapitalized institutions to become effectively small banks. And we saw that didn't work.
It was a little more complicated than that because the regulation limited how much they could pay for deposits at a time when interest rates that were unregulated had gone through the roof. And so if the banks could loan at 22%, the savings loans wouldn't have any business if their passbook accounts were capped at 4%. And that's so they had a mismatch between
There
their
was a mismatch
assets
of
and their
capital
liabilities. Yeah.
utilization.
Yeah. And so anytime you have that extreme a change in the interest rates between one banking system and another, they're either going to have the same system or
What was
one's
the
going to fail.
thinking there, Terry, to cap the rate for
Well,
thrift loans?
the idea was that it would be a good, safe investment. Have you ever heard of a Christmas club where you set aside $100
Yeah.
a month, and then you'll have $1,200 at Christmas, or $10 a month, I guess in my case at the time, $120 at Christmas to buy presents. And so they were very much retail neighborhood, but some of them were quite big in real estate. So Home Savings in Los Angeles, Home Federal
Time.
in San Diego, those were the giants of real estate finance, certainly on the West Coast. And but because of the financial circumstances, mostly they were all upside down. And so,
Home savings got swept into that. I remember toward the end of the
yep,
RTC crisis.
exactly right. Yeah, but a Union Bank out there had Union America. That was another REIT that was sponsored by a bank that became upside down.
So this
Uh,
is like 94, 95,
This, no, a little bit earlier. It was
92?
between 86 and 90. I think 90 or 91 is when the RTC was established.
Right.
And so the RTC was in effect uh, liquidating financial institutions and selling loans and properties at 50 cents on the dollar. And it was another time like 1974 when the problems were great, and which is a great opportunity for an entrepreneur because mostly we get paid for solving problems. And so I learned a lot of problems. I always want to reassure people I was the fireman, not the arsonist. But we had a chance to buy real estate at an advantage. I helped the Federal Home Loan Bank for $1 a year as a volunteer to liquidate 3 of the savings and loans. And so just you have a chance to see how the world works, how you create value.
You're doing what I'll call deep value add investing,
Well,
fixing broken structures, so forth.
sometimes
All
broken
still
structures.
pre-Aimco. This is all
It's
pre.
all pre-Aimco. So sometimes it's the the balance sheets that's broken. Sometimes it's the operations. Sometimes construction wasn't complete. Sometimes it wasn't leased. So you have to deal with every kind of problem.
But I always
The-
tell young folks who haven't been through a cycle, you will learn more and build more character in a down period than you will in an up period.
I want you to remember that and call me and remind me of that because we're in one like it right now. And so
Well, we're in a drought right now.
yeah,
We're in this long, long malaise following artificially low interest rates that this has been one of the longest dry spells of value that anybody can recall.
well, as I say, I remember a couple of these, and I think Bob, what's similar is there are a lot of properties today that were based on the assumption of very low interest rates, or are less supply than later happened. And so there's an awful lot of properties that were capitalized across other asset types, but including apartments that are not worth their cost. And there are a lot of trades that we've made of properties that where their economic value today is 50, 60% of what was paid for them.
Yeah, it's not unusual. So let's talk about the formulation of Aimco going public and
Well, I had I've forgotten, I think 5 or 6 thousand apartment units that I'd
really.
syndicated, and I'd also acquired a couple of management companies along the way. So I had about 25 or 30,000 units that I managed for third parties.
So you were accumulating a management book.
A management book as a discipline and also as a way to access property. So when I went public, I included in there about 10,000 units that had been owned by a savings loan and by Pima Savings and Loan in Phoenix that had failed, and actually in Tucson that had failed. And so those were held by a receiver by whose representative was a lawyer in Los Angeles at a law firm there named Peter Campagnas.
Uh-huh.
And so Peter was my partner in doing that, and we put in our units and his units and those of some other friends. Another great California name, Alex Spanos, was a friend of
Sure.
mine. I'd done deals with him. He gave me three properties, and we took it public in July of '94.
You ganged it together with some other interested parties to form it.
Right. Well, my
You all took
intention.
shares in the new REIT?
Yeah, my intention had been, as you remember, I told Betsy I was going to simplify my life, and I was going to be able to drive the kids to school, and I was going to learn to walk without crutches. Well, I was still on crutches, and Paul
Sure.
McAuliffe, who's a very able investment banker, was running the IPO, and he came and he said, "We don't think we can do the IPO unless you'll agree to be the CEO." And I said, Paul, I want to do the IPO, but I can't be the CEO because I told Betsy I'm going to simplify my life and I'm going to learn to walk without crutches, and I'm just getting started on that. This would have been a year after I got defeated in '92, and he said, you only have to do it for a year. Well, 30 years later, so you can understand I'm still in the doghouse.
You're a reluctant CEO. Let's get this straight.
Well, I was reluctant, and then it kind of grew on me. I thought it was pretty good fun, and we had a lot of time. We doubled every 15 months for 8 years.
And you were one of the early formers of apartment REITs, as I remember, right?
Well, there were I
Sam Zell already doing his thing by then?
who?
Sam Zell.
So Sam was doing that. Archstone came out at that time. Camden came out. Was out. Rick Campo is just
Mhm.
retired. Rick's a very able guy and a good friend. Bank of America REIT, which became BRE, was out. George Marcus came out a week or two after us with the Essex.
So all
Um,
around that
mhm.
same period of time.
Same period of time. That was the REIT window, and there were about 30 apartment REITs, and they've been consolidated down to probably 5 or 6 big ones. But we bought half a dozen of them, and that's part of the way we grew.
Do you remember those names who you bought?
Well, we bought the REITs Ambassador is the one that comes to mind, but I also bought NHP, Insignia, the
HP was a DC based firm?
DC based. It was a congressionally chartered company that had been owned by Warren Buffett and Harvard endowment, and they did a lot of things right. And Wes Powell's father, was the top deal guy at NHP.
Warren
So
was involved with apartments back in those
yeah,
days.
back then. Mhm.
Because his now deceased partner, Charlie Munger, got into the apartment business later in his life.
Yeah, I've read that, and I know Charlie's
I did a
daughter.
couple deals with him.
Oh, well, so what an interesting man to know. I wish I'd
It
known
was
him.
fascinating,
Yeah.
very humble, very similar to Warren.
Very, very wonderful, very clear thinker. Um,
Very.
but yeah, so that's what we did then, and what happened is markets are more dynamic. People tend to think that there's status quo, but during that time, well, over the last 50 years, if you go back and take the 50 biggest markets in America, the U.S. population grew by 68%, but in 11 of those 50, it declined, and it declined by, in the case of Detroit, 65%. So I mean, you have
But it
radical.
declined in certain cities, not as a country.
No, the country was up 68% in that time period.
Yeah.
But of the 50 largest metropolitan areas, not just the cities, the SMSA, the population actually declined in 11. And if you think about, well, that was the Rust Belt phenomenon, Detroit, Cleveland, Milwaukee, St. Louis. but it was also, if you look at the last 10 years, I think seven of the large metropolitan areas lost population. In
Well,
the
we're
last
now
10,
in a period where we're actually, again, declining, and we've never had that in recent times with the more stringent immigration policy, less lower birth rate, and baby boomers getting a little bit older and tapping
and,
out.
and people being mobile and just the migration of people to different states that for whatever reason, whether it's taxes or the weather, that it is a more dynamic world than I think people tend to think. When on our 25th anniversary of our Aimco IPO, we went back to the New York Stock Exchange. They asked us back for sort of a celebration.
Isn't that great? I've been
And
there
they,
once.
yeah, well, it was
Good
pretty
bill.
exciting, pretty exciting. And they said in the we're in the S&P 500, and they said in the S&P 500 we were about the 180th most senior. In other words, during that time we had started at 500, but worked our way up to 180 on our way. And when we split Aimco, that took us out of the S&P 500, and we were replaced by Tesla, which hadn't existed 5 years before. So
Well,
that
that's a pretty good name to be replaced by.
well, I wish some of it had rubbed off on me more, but I think that it just shows
Well,
how
you need to have more wives, more kids, and like to play around with rockets.
it'd be too complicated.
That is so not you, Terry.
Yeah, but the real estate in some ways seems very staid and predictable,
Mhm.
but in fact
Durable.
it is very, there's a lot of turbulence to it.
Yeah,
And
there is.
investing, you need to balance those risks and to know what they are and kind of see around the corner if you can, but if not, figure out what you do to deal with them when they come, whether it's political regulation, rent control, and
Yeah.
industry relocation. What's happening in Hollywood right now with film production
Sure.
may or may not change the economics of having apartments there.
Yeah, you bought a very attractive piece of real estate in Hollywood, California, near the center of entertainment, with I think Ron Dickerman's company, Madison.
Yeah.
So even though we've had a slowdown of production in Southern California, where a lot of it's moved to other states and foreign countries, you saw an opportunity there despite that. Talk about that.
Well, you mentioned Ron. I've known Ron since he started his business in the 90s, rolling up partnership units, and
Yes.
we're a big buyer of those. And he's a wonderful man, and he's made a great success of it. And so I'm proud of what he's done, and I'm proud to have him as a partner there. And my thought was, with all the headwinds and challenges that we're talking about in Hollywood, what's different than say 20 years ago is all the new housing that's been built, the metro line that's been built, the emergence of Netflix and now Paramount, and so there's a lot going on there, and my cost basis was one half of
So
what it cost to
this wasn't a
replace.
distressed deal, right? Or was it a
It,
time's up situation, or
it was a case where the economics didn't support the capital structure.
yeah, which is pretty common right now, and
Yeah. And
people
so
that
what
bought deals.
we do that just gives us a little advantage, and it's a lot of what you do. I've watched you over the years, and you're really good at operations, and you're really good at asset management,
Thank
and
you.
that's what we try to be, and that allows us to say, well, maybe we can operate this and increase the profitability of this particular property.
Now, let me ask you a question, because I know from my experience in having done a deal with Ron's company, their whole thing is recapitalizations.
Yep.
So how did that fit this box, or did it not?
Well, it did, because originally we were talking with a general partner and then with a limited partner, eventually the lender.
Okay.
And so it counted as.
It had the hint of recapitalization
Yeah.
into it.
Right.
And how's the property, it's 3 buildings, right? Or 4?
It's 4 buildings. There's 609 units, 60,000 square feet of commercial space, 1,200 parking spaces. It's
El
half a
Centro
block,
and Hollywood Boulevard?
yeah, half a block west of Plantagenet. I mean, it's an iconic location,
It is.
and yet there's a lot of new supply and there's a lot of competition.
Right.
And we have to be a little bit better operator than not just our predecessor, but we have to work hard to do a good job.
Would you call it a contrarian play?
Um, my wife says I'm contrarian, but sometimes I think she means something different than I think you're thinking of. She just thinks I'm being difficult. But yeah, I'm happy buying things that when nobody else wants them.
Well, I want to go back a little bit because this was under the new banner of Big Four.
Yeah, that was a big Ford deal. Mhm.
Let's go back because I know at Aimco, you bought a lot of platforms. You bought a big chunk of the Flatley companies that operated.
I bought all the multifamily.
You bought all the
Tom
multis, and
Flatley
some of
was
them I just saw went out to the market through the successor to Aimco. They were selling them. One
Yeah.
up in Andover, one down
Yeah.
in I think Pawtucket, if I
Yep.
recall. I remember looking at that one a number of years ago.
Yeah. Well, those they all looked alike. He used the same.
Tudor, that sort of faux Tudor deal.
Exactly right. He was a wonderful man. He was an Irish immigrant carpenter who made his way onto the Forbes 400 and was
Really?
a lovely, decent man. Like you, he spent a lot of his time in philanthropy. He's very involved in Boston charities, and he was just a man I admired greatly.
Is that name still around, Flatley? Is the company still around?
No, I don't think so. But the alumni of his firm are some of the most important developers in Boston.
Yeah, he bred a lot of
A lot of people,
lot of
and his
developers. I
teams were
remember.
very loyal to him. We bought all of his apartments, and we probably had owned it for 4 or 5 years. And I wanted to make some change, not consequential, but at an entry gate or some such. And the community manager said, "Well, we're glad to do this, but have you cleared this with Mr. Flatley?" I said, "Good point. Good point. I better go
They were
check."
used to hearing from Mr. Flatley, not Mr. Considine.
Exactly right.
But Terry, you're not afraid to take on. I'm going to be careful here. Strong personalities. You did a lot of business with Alan Kasdan, whose reputation precedes him. But I'm not going to go here because of the nature of this
Well,
podcast. But it
Alan,
tells me a lot about your abilities.
Alan, it had a very good eye for real estate, a very good eye
He was a good developer in his day.
He was always. We had a respectful relationship. We had him build the plazas for us in Mid Wilshire. I mean, that was his dirt, but we had bought it, and so he built it out. And
Right at the edge of Park La Brea.
right, exactly right. And that was a clever land assembly. He bought those out parcels around Park La Brea.
That building is close to, or is the same building the Erewhon, the first Erewhon was in?
It's close to. It's a block away. We bought that. That was Broadcast Center, and
Yeah.
we were the Erewhon's landlord. And
Little did you know that was going to be so successful.
well, but we benefited from it. They had a very difficult time, maybe 2001 or two when they were getting
Started by a
started.
Japanese couple, as I recall. It was a small grocery.
I don't remember them as Japanese, but
I believe so.
Well, and they needed a break, and we said, we'll lower the rent, but we want a good percentage rent.
That's before
and-
they were selling $30 juices that Tony Antucci now sells there. Like
They weren't
people are going
charging
to a
that much
candy
then.
store. Huh?
But we ended up we had I think $1 million of percentage rent a year there, so that was I was rooting. I thought it should be $31 a juice.
Well, you're not afraid of mixed use. A lot of apartment guys don't do as well with mixed use as you've
Well,
done.
at the land trust, I've done a lot of malls,
Yeah.
and I just there was an interesting business journey from doing regional malls to doing apartments, because in regional malls you get a percentage of the tenant's business, and I began to think that really in the apartment business it's a look through to the income of our residents, and so
But I need to hear at least one affable Allen story here for the viewers. If people don't know, I think we should give them a little education here of his.
you'll have to do it.
Yeah,
Because
you do it, Terry. Come on, that was your partner.
Well, Alan was colorful. He was dynamic, and I hope he.
You knew where you stood with him, that's for sure.
I had to settle a lawsuit between him and his brother. I mean,
Yeah, I think they got into fisticuffs or something, didn't they?
not when I was there, but I didn't. I have seven brothers, so I understand feelings can get high, but I didn't think they should sue each other. So, but I'm not going to say a bad thing about Alan because
No, but I'm impressed though that you did as well, so well buying those assets. The timing was impeccable. And then Alan took that capital and did other things with it, as I remember.
Yep, yeah, that was part of it. But I think my takeaway from all of that is that the world keeps changing, and you just have to see where it's going and try and either get in front of it or at least not get left too far behind. And I think I'm just it's very vivid to me having stepped out from the somewhat isolation, if you will, of running a New York Stock Exchange S&P 500 company to starting a Big Four properties. It gives me an opportunity for a fresh look, and there are things that I look at that I was doing 2 or 3 years ago that I wouldn't do today. That I know better about markets, or I know better about structure or operations.
Well,
And
it's the
just have
reason,
to keep thinking.
Terry, why there's not a lot of loop public REITs because of how difficult it is to manage Wall Street expectations, earning expectations, compliance. I mean, would you, if you had the time to do it all over again, would you have done it the same way, knowing what you know today, to be a public REIT?
I don't spend a lot of time thinking about the past because I can't change it.
I'm thinking about it more for an advice to.
But surely, I made 100 mistakes in my life, and I would do them differently if I were to relive it. What I found during the last period of time of Aimco was I was raising more money from third parties, from people like Blackstone, from people like Brookfield, from people like sovereign wealth funds that were deeper, more liquid, more better priced capital than the public markets. And so a little bit that didn't exist. The private markets weren't that liquid years ago, decades ago. And so today, the people that are the reason they're not more
Markets
public,
weren't as liquid for real estate as they are today.
that's right. And the reason, and you just see that with our good friend Bill McMorrow, that's a case where he chose to be private now rather than public.
Well, I think in Bill, similar to a period of time at Aimco, where Wall Street was not rewarding your profits or Bill's ingenuity or what have you at the stock price pump.
Well, that's exactly right. So I think what I would say the second reason there are not a lot of new public REITs is that the entrepreneurs, real estate and apartments lend themselves to entrepreneurs, and so you and 100 of our friends that run large apartment buyers, whether it's Cortland or Kane or Harbor or so forth,
Yes.
are more attracted to the private market because it's a better opportunity and they have just as good an access to capital as if they were public.
Well, we're all of those folks you mentioned, Steve DeFrancis or Jonathan who runs Harbor Group or myself, we're still fiduciaries.
Oh, yes.
We're just not public fiduciaries. We still follow compliance rules, but I think we can pivot a little bit easier. We can't form capital quite as easily, but we can definitely pivot.
I think you can raise capital at more attractive pricing than public. And I think you're more dynamic and you probably spend less time on governance and investor meetings. As much as you spend, it's nothing like having investor calls and I spend 25-30% of my time at NAREIT meetings and things like that.
I can only imagine. So let's take it all the way just short of Big Four. I think the Aimco, you were looking for a way to figure out succession, to maximize value, and you came up with this concept to split Aimco into two different buckets. Talk about that, the timing, why, etc.
Well, some of it was the year. It was 2020. It was COVID, and I felt that I 70, 80, 90% of my workforce was essential, and I couldn't bring myself to go to the ranch and watch Netflix. And so I traveled all that time to be with my team. And just with that time thinking about it, I thought, well, maybe we can get a better valuation if we simplify the company so that AIR was the simple company and Aimco had everything that was complicated, like development, left behind.
So the Aimco side took the assets that were more difficult to value or had some, I will call it hair for lack of a better
Yeah,
description.
sure. And sometimes it was just that they were valuable land. So we had two properties in Brickell that
Remember when you ventured to Florida with these big
yeah,
high-rise deals?
that's right. And so at the time I thought that those two properties would have a higher value for someone to build, and that's been confirmed. Wes Powell, whom I mentioned, who's such a brilliant friend and real estate man.
I hope
sold
all his friends are going to be listening to this podcast, Terry. You
Well, I
just
hope so, because
keep raising his stock potential. You're good.
he knows I admire him, but he sold those two properties for $650 million, and they're going to be torn down, and it's going to be a $3 billion development there. So I mean,
Is that right?
right.
How long ago were they built?
Um, I've forgotten that there were two properties. One was an apartment property, and I've just forgotten it, but it had been built about 2000 or 1995.
And they're being torn down
Oh, absolutely, yeah.
to build a mega development.
Because right across the street from us was a 90-story building. I mean,
Wow.
Brickell has the highest amount of high-rise building outside of Manhattan.
Terry, I get it. I'm paying some pretty good rent for my team down there. So I feel the love of Brickell.
It's great, but Wall Street doesn't have a good way of thinking about land value. So our Flamingo there would be another example. I bought that for $60 million in 94 or 96, somewhere in there. And it was worth $1 billion when we sold it to Blackstone. And we put some money in it. We built one building, but just land value is the key to a lot of real estate wealth. And
it's incredible, the land value. That's like New York City.
Yep, but Wall Street wanted to know what our FFO was per quarter. Now, FFO is a very incomplete measure.
Right. It only tells one part of the story.
Yeah, and I always thought it was important to talk about capital replacements, and I always thought it was important to talk about land value.
So you unlocked this hidden value, at the same time created this separation,
Sure.
which you could then monetize cleanly.
Yep.
And send off into a different orbit, which created both an exit strategy for everybody, a home for all the people, and a good custodial place with Blackstone, and gave them vertical integration. So it was very good for them, very good for you.
Right. Mm-hmm.
And then you put the remainder assets.
You probably know Asim Hamid, who's
he's a partner of mine.
Well, he is a able, nice, great friend of mine.
Very good guy.
We had a joint venture together before, and he was the one that saw the opportunity for Blackstone to benefit from having a platform for its, probably another 400 properties.
The ethos of the Blackstone team is such that not only are they aggressive and good professionals, they're nice people.
They are nice people. They're nice people.
I'm proud to be partners with them, as I see you are. So let's quickly talk a little bit about the new Terry's coming from backstage now, back to the front of the stage for an encore or two. This is like your third encore.
Yeah.
Why Big Four? Why now? You're in Hollywood, you're in Louisville, you're in Overland Park. You even bought that little deal that I looked at in and at Charles Bank deal, you bought the building across the street. Okay,
Yeah,
I know
yeah,
what you did.
yeah.
And then you going from there. Talk about
In La Jolla in Washington, D.C. Well, I love what I do, and
you're a
I
deal
love
junkie
the
like me, Terry. Let's get it straight.
well. There's part of that, and there's also I'm a as I say, the great influence of my life is my family. I love having family, and so my colleagues are kind of an extended family.
Yes, they,
I love them to death. I enjoy their success. I'm blessed that they're so able and hardworking, and it's just a joy. So Matt O'Grady, who's a national champion oarsman at Harvard, worked on Wall Street at Lazard for 10 or 15 years, and
part of your Big Four team.
he was doing capital markets at AIR, and then he came over with us. Josh
There's four of
Minnick's,
you to form Big Four, right?
yeah, that's exactly right.
My keen sense of the obvious, Terry, was kicking in when I heard that name.
Well, the Josh had done it with had been a group that formed a syndication firm while he was at Harvard Law School, and then he went on. He was head of multifamily in North America for Partners Group. So he'd been on both sides of it, so he knew a lot about institutional buying and
Big
about
firm.
knows everybody in the business. And then Matt Island had been with me at Aimco and AIR, and really had been, I think, my thought leader partner.
I told you you're like Mick Jagger. You got the whole band back, okay? You got the drummer, the singer, the guitarist, and Terry out in front.
Well, there are about 10,000 teammates we still have to make room for. But
well, one thing at a time. I mean, Big Four will do its thing, and I'm sure it's going to be a very interesting deal. So, Terry, you have a great entrepreneurial mindset. I mean, I think that's your secret sauce. You've built these platforms. Now we're coming up on 5 decades. It's the team, it's the kill, it's the essence of what you do that keeps you motivated. But if you could just tell us, for the benefit of the younger viewers, okay, who are early stage career, what would you say your secret sauce is, if you had to summarize it?
I think I think we've touched on it earlier, and we've touched on it in a couple of the other factors. I think the most important thing as a business matter is to find something you love, and the most important thing as a person is to find a woman you love and have a family, and be comfortable that you're doing the right thing, and that money is a result, a byproduct of something we all like and appreciate, but it's not the most important thing. It's more important to do good work, to satisfy our customers, to create a place where people want to be on your team and work with you, and those are the things that have meant the most to me. The relationships and the feelings, not just for customers. We have telephone trees for service requests, so that if you can't get the property manager, you get the regional manager, you get so forth. And I was always at the end of it. And it was rare that it got to me, but it always happened on Christmas Eve. And Betsy would say, we're getting ready to go to midnight mass. She'd say, well, why are you taking this person's call? You can't fix her oven. She's in Washington. And I'd say, because Betsy, she's our customer. We promised that we would take care of her. And
a lot of CEOs won't take those kinds of calls or now emails. Well, that's amazing, Terry.
I just always felt that was the deal we'd made, and I wanted to make sure that she had an oven when her mother-in-law came to, which that's a real story.
I'm going to have my daughter move in Boston to one of your buildings, so that if anything goes wrong with that apartment, I know your cell number, I know where you live. It's perfect.
I love that, and I'd be welcome. And we have very high qualifying standards, but she comes from good stock, so I think she would be a very good choice for us. And I know
you treat her fairly.
She's a talent. She's a talent. We'd love to have her.
Thank you. So Terry, when we sum it all up and kind of reflect back on this unbelievable career of 5 decades, from the early days, the pre-Aimco days, the formation of Aimco, creating the AIR and that separation, to now building Big Four, that's off to a great start. Of all of that, what are you the most proud of? And talk about how that informs what you're excited about today for the viewers before we conclude?
I think, like you, I'm proud of my family. I'm very proud of my children. They're three very different individuals. They've accomplished a lot. I'm proud of my marriage, which life is not marriage is not easy, but if you work at it, it's very rewarding. If I'm proud of the financial returns I've earned for shareholders and investors. When we sold AIR, uh, uh, Tony Mano at JP Morgan came out to bought his whole investment team to Denver to buy us dinner because he had a big investment in the company, and he thought it was a very good outcome. And I thought that I felt great that I'd done a good job for him. It
Process of doing a good
matters a lot
job.
to me to do a good job. And I'm just was touched by how many of my teammates called to say, if you want to do it again, count me in. Those are
Wow.
things that kind of touch my heart.
Count me in.
Yeah.
Count me in.
Mhm.
Terry, incredible insights. Really appreciate you sharing. This was a really great conversation, one of the best podcasts we've had. Terry, the viewers, if you're just tuning in now, Terry Considine, consummate entrepreneur, public CEO, former state senator of Colorado, and now back to being to his old roots of raising capital as a serial multifamily entrepreneur. Thanks for coming on, Terry. Thanks for listening, everybody, to Building Better Communities. I'm Bob Hart, and we'll see you next time.
Be well, and thank you, Bob.
Thank you, Terry. Have a great day.
You too.
Bye-bye.